I really just think the timing on this is quite off. Does Labor not understand, the struggles that day-to-day Kiwis, business or not, are going through? If you are a mum and dad and you've got one investment property and you both have jobs, and then you sell that investment property and you're planning to use that capital for retirement, for example, which is something we deal with regularly, and was it 28% of it is taken away, that has a flow-on effect for them immediately, and then it has a flow-on effect on the economy.
We are back in your life, and today Labor's announced a capital gains tax in 2027 if they get into government. I've got Mike and Matt here with me today. Gents, no surprise?
No, I don't think so. I think we all called it. It's no surprise that Labor is bringing it in because they're in opposition, and it's not really National's usual play to bring in a capital gains tax like this, but no real surprise across the board. Matt?
Well, you know what is also no surprise? It's no surprise that they said they wouldn't bring a capital gains tax in, and then they did. Well, they're proposing it.
Yeah.
Well,
so no surprises then.
Yeah, they said they wouldn't do it while they were in power, but now they've been kicked out and they want to get back in. Let's break it down into, opposed to actually how this would work in reality and what it means for people. Let's talk about the political side first. I think you're right. Labor stayed away from it. They tried, and then Winnie stopped them in the early 2020s. Now they've got, most people thought that they would have to go a little bit more towards, whether we're talking about a wealth tax or a capital gains tax or some form of an additional tax. So you're right, Mike, not that surprising.
Yeah, and we're one of the few countries in the world without a capital gains tax on these assets, so kind of makes sense to come in.
And I definitely agree with that because everyone knows that we're one of the few countries in the world and in the OECD without it. But what is also relevant, and I promise I'm here to be a balanced, responsible member of the business community, but what is also a stat that is relevant is that we are the second highest tax country in the OECD already, without a capital gains tax. And I've been on these with you guys, and we've talked about other types of taxes that aren't necessarily as obvious: fuel excise tax, alcohol excise tax, every little fee you pay when you go to a government agency, etc. So I think, does New Zealand need this tax? Maybe eventually. I think a capital gains tax has been on the cards. It's only a matter of time. But I want to back it up a little bit and go, given all the struggles and adversity that New Zealand's already facing, our economy is slow, productivity is low. Is the timing right? One, to put this on the table, and two, to implement it.
Yeah, they're just throwing something out to try and get re-elected, right?
Seems that way.
I think what is quite interesting was it's for residential property and commercial property. When this happened, I always assumed it would be include business sales and obviously shares as well in terms of capital gains tax on shares. What do we think about it just being, residential is not surprising, but the fact that it's resi and commercial and not those other assets.
Got to get those resi investors.
Yeah, I genuinely think, unfortunately, in this scenario, commercial property investors, they're just collateral damage here.
I'm going to get in trouble for that, I think.
Probably. But I kind of feel like they're just being, and it is the same asset class to a degree, but they're just kind of being lumped in. In a perfect world for them, and I mean this as apolitically as possible, in a perfect world for them, they would have gone, okay, we're just going to tax residential property investors, and we're going to give you 3 free GP visits a year, because that would have done exactly what they probably wanted to do, which was, go after the bad guy, the property investors again, and then give it to someone who potentially wants, some free stuff, right? However, they couldn't, because it's just going to look like they're targeting people too specifically, right? So they've lumped commercial property in there as well as a little bit of collateral damage to be like, no, we're not just going after them. It's everything. We're being, a bit more holistic with this. Where I actually, if they could have, I don't think they would have bothered lumping commercial in there at all.
And it's interesting because I haven't spent a lot of time thinking about capital gains tax, other than the fact that when the interest deductibility rules came in, my overriding opinion was and still is that I'd rather have a capital gains tax. And I think there's definitely places where a capital gains tax within our tax system is appropriate. But I'm with James, if you're going to do it, don't go a half hat on it. It should apply to all capital transactions, because and I know you're going to say it shortly about farms.
Yeah.
What you do is you create that inequality in the tax system. And we had that when we had the interest deductibility. We had 2 types of investors. One had a new build, they get to deduct the interest. The other didn't, they don't. That
inequality, look at the distortions it made in the
doesn't
market.
work. So I'm now I'm now incentivized under capital gains tax to have a bigger first home, and we've discussed this before. But more than that, I am incentivized to have a farm.
Yeah.
Let's talk about the farming piece. So the farmers do listen to the podcast at 5 a.m. while they're milking away. This might be a little bit controversial. Why would farming be excluded from this?
How do you want me to answer it?
I already get in enough trouble. I'm not answering.
Yeah, I'll answer this one. How do you want me to answer it? Do you want me to answer it from like,
tell us what you think, Michael?
Here's
Get off
why
the fence.
here's why they would say they're going to exclude it, or here's why they probably actually have excluded it. If it's the first one, what would they come out and say? They would probably say something like, "Look, farming's the backbone of the economy. We back these guys. You know, they go through enough hardship and all this
We're
sort
a
of
net
stuff.
exporter.
Yep.
We need them. Like if without agriculture and horticulture in our economy, like we don't have one, which is the sad reality.
So that's probably the headline. Why would they actually exclude farms? Votes. You know, they will just say like, "Hey, look, everyone else. We're going to go after again someone who's really easy to go after, property investors." And we're going to give someone else a break. It's actually quite easy to give a break to farmers. And I do not want to go after the farmers here, but it's just going to create distortions in the market. And when you have these types of two-tier tax systems or certain segments that get treated slightly differently from a tax perspective, I'm incentivized to be part of that excluded. Do I want to be a farmer? How many chickens do I have to have on my property before it's a farm?
Yeah, and let's not kid ourselves, right? When a political party comes out with a policy, that policy 100% has been designed to get the maximum amount of upvotes and the minimum amount of downvotes. And they would have had working parties. Yep. They will understand who this is going to affect and how they're going to vote.
And National's no different.
No,
every party does it.
100% they do. Every party does it. And back to your question about businesses and shares, interesting that they excluded those because, what you would have thought by and large that a lot of business owners would be not Labour Party voters. So if you tax them, well, you're not getting the vote either way, so just tax them.
Yeah, why wouldn't you go all of the way instead of part of the way?
Yep.
But I do agree in terms of the voting component. Like if you got 5 million people in New Zealand, there's 1.5 million people in Auckland, maybe 500,000 people in Wellington, 500,000 people in Christchurch. There's a very big chunk of New Zealand, which is regional New Zealand, which is impacted by, because it's not just the farmers, right? It's all of the suppliers around the farms as well. Yep. And if you have a policy which impacts it is actually a lot of votes when you think about New Zealand's population.
Yeah, I think the interesting piece as well is coming out at the same time and saying what you're going to spend it on, and that what you're going to spend it on is every Kiwi gets 3 free visits to a GP or doctor per year.
Yep.
So you, on one hand, are going, we're going to go after people who it's pretty easy to go after, and we know that there's 14% of New Zealanders are property investors or something similar to that stat. And then we're going to turn around and go, and everyone else who isn't a property investor, you're going to get it. You're going to get something from this.
Yeah. I coming back to the point though around obviously businesses align much more with a national policy than a Labour policy, right? That's not any secret. When you think about like investing into the share market and businesses, why didn't they go the whole way? Why did they go part of the way in terms of the policy?
And they'd be scared of just putting off voters.
Yeah, optics. I think it's optics, and I think it opens the door for them to then do it in the next round of changes. And that's something Labor's also very good at, proposing and getting the start of the rule in and then making changes.
Yeah.
And I think looking at the wider impact of it, right? Any extra tax in the economy, no matter who pays it, it doesn't matter if the farmer pays it, the property investor, the business owner, that tax it reduces the capital that's available in this country to do more. Because that capital goes to the government. We can agree or disagree on the government, but I don't think any government spends it as like you'd want it to be spent realistically. And so what it does is it reduces opportunity. And I really just think the timing on this is quite off. Does Labor not understand, the struggles that day-to-day Kiwis, business or not, are going through? And if you are a mum and dad and you've got one investment property and you both have jobs, and then you sell that investment property and you're planning to use that capital for retirement, for example, which is something we deal with regularly, and was it 28% of it is taken away, that has a flow-on effect for them immediately, and then has a flow-on effect on the economy.
Yeah. One thing though, I would like to say that is good about this policy is it is quite simple to understand.
Yes.
Like 28% tax, no interest deductibility rules,
Yeah.
no pulling all these other levers which happened when
Yep.
they couldn't get through capital gains tax. That if you are going to look for a positive within all this, nice and easy to understand.
Yeah, and I think one of the other positives is it opens the door for further conversation. Do we prefer capital gains tax as a country? Do we prefer no interest deductibility? Do we prefer wealth tax? Whatever. Do we think they've done enough, not enough? Do we think the timing is right? And anytime there's some conversation, it's been leaked. It means there can be some discussion, and what might come of that is something different.
Yeah. So, the obvious questions from here is, do we think this is enough to get Labor elected? How do you actually implement something like this? If I bought a property 30 years ago and I'm paying tax on all of this, there's so much to unpack, and we're going to go through all of that after this break.
Hey guys, thanks for tuning into the podcast. If you like what you hear, make sure you rate, review, and subscribe so we can get the message out to more people. Now, back to the episode.
All right, guys. So let's say Labor get elected. Let's say they put in this 28% tax rate on property come 2027. How does something like this actually get implemented in New Zealand?
Yeah, I think there's three approaches as far as I can tell. So there's my preferred approach, which I will be biased. I am a property investor.
You don't say.
Yeah, there might be a few hints, is that it doesn't apply to any assets purchased pre-2027 date. So I would get away with it. I think that's unlikely. Option 2, which I think is the likely option, is that they take a valuation approach. So on that option, the day before the law comes in, we basically get valuations. And you imagine this will be a huge boon to the valuation industry. It actually will have to be something quite well planned out, I'd say, unless they say you can take CVs or other stuff, but even then, manipulation. You get it valued the day before, and then the next day, the clock starts. So any gains that have accrued to you during that period where no capital gains tax existed are yours and are tax-free. That's called grandfathering. And then anything that accrues from that point on would be taxed.
Yeah.
Tell us about option 3, Matt.
Option 3 is that everything is taxed.
So if little Mary bought an investment property in 1982 for 70 grand, it's now worth $1 million.
Yeah.
She's up for a big tax bill.
Yeah. So, and I did it in order of unlikely, likely, very unlikely.
Yeah.
Just kind of out of order.
Yeah. I would have thought you're right. One would be nice, but unlikely in terms of properties bought from this day forward. The implications and the horror stories with the last option would be terrifying.
Yeah.
In terms of how you value a property, I guess the question is, do we just take a core logic or something that the bank would take? We know that they can be very wrong.
Yes.
How would that actually work?
Yeah, reasonably speaking, you're in order of least accurate to most accurate. You have your CV, so your just the council valuation. You then have your your online valuation, so that's what we use from CoreLogic Velocity, and then you have your registered valuation that comes out where someone comes out to the house, looks at it, assesses it, compares it to other sales in the market, and then puts a valuation on that. That is anywhere for a resi property, somewhere between like $900 and $1,200, sometimes plus just on that as well. So to Matt's point before, all of a sudden, if every residential valuer has a deadline date, and they price depending on how busy they are. So if they're really busy, that's going to get quite expensive. And again, does that create a distortion where people with more money get a more accurate valuation? It's usually higher than your other valuations, and then probably pay a little bit less tax on it. That is a potential outcome. What I think would be quite interesting, though, is, again, it's always the lawyers and the accountants that win, right? And if there's potentially a capital gains tax coming in, do people then try and stash the assets in a family trust? A lot of these houses are in family trusts, and then all of a sudden you're not actually selling the properties. you're just hanging on to them for generations, so you don't have to pay the capital gains tax.
Unintended consequences.
Yep.
Before I answer that one, I just want to go to those options that you talked about and think about, like, realistically, the only organizations in this country that do bulk valuations are councils.
Yep. Yeah.
And they are notoriously wrong. And but if you're a government and you're going, like, how do we get this implemented easily? Well, I think the obvious answer is you go to CVs, bulk valuations, which are notoriously wrong. So I think there's some things to work through here.
Yeah.
The unintended consequence of just passing assets down. Yeah. I mean, I think first of all, accountants, lawyers, valuers potentially are going to have a very massive windfall from these new laws. And you think about the number of property transactions just in this office, and then extrapolate that over the country. And you know, maybe that's a good thing for accountants. But it's going to add compliance costs to people, because not only are you going to pay a tax, but you're going to pay someone to work that tax out.
Yeah.
Probably there's going to be a withholding of it by the solicitor on sale, I would imagine. So you've got all these extra fees on top of it. All this stuff's just slowing the economy down.
Speaking of slowing the economy down, so Nicola Willis was interviewed about this, and she said a tax on savings, investments, and growth is the complete opposite of what our economy needs right now. She said Labor's tax grab would put New Zealand's economy recovery at risk. It's a recipe for fewer jobs, lower incomes, and less savings. She also warns that every business needs somewhere to work from, and many depend on property. Labor has effectively committed to a tax on businesses, small and large, from the corner dairy to the local factory.
Yeah.
The rhetoric.
Yeah. I don't 100% agree with that. Like, property as it stands isn't a particularly productive asset for the economy. It's not like it employs a ton of people when you go out and buy an investment property. So I don't think there's like a huge downside risk from that perspective. The commercial stuff, yeah, she probably has a bit more of a point there, but from a residential perspective, I don't. Yeah.
What do we think about the sentiment around, in terms of where the economy is at the moment, and business confidence, and the feeling that it is, I completely appreciate that property does not equal business, but they're just intertwining about how people feel and that they're wanting to get out there and do things. What do we think the impact is there?
Yeah, and I think whilst property is unproductive, and I definitely agree with that, I think that what comes out of property, all the industries attached to it, and the money that comes from those capital sales and often is put into businesses is really valuable. As I said at the start of the episode, like, eventually we'll get a capital gains tax, but I don't think the timing's right. I think I agree with Nicola Willis's sentiment in that the economy is struggling, and anyone who thinks it isn't needs to look out the window, needs to look at their own bank accounts, whatever. It's struggling. It's going to take a long time to recover from COVID spending. It's going to take a long time for us to get confidence back as a business community, and for the people to stop moving overseas because they don't see any future here. And I think another tax is going to feel exactly like that, another tax.
I absolutely agree with Matt from that perspective. Like, it is just the wrong time to be talking about this. And I'm not saying like we're going to be living on this tax-free, no capital gains, stuff forever. I think everyone in the room agrees that like we probably should have a capital gains tax at some point. But to Matt's point there, I just think this is the wrong time. And to say in 2027 we're potentially going to put this tax in place, even though they might argue, well, we're not putting it in now. We'll be in somewhere a different place by 2027. Yeah, when I talk to people about making plans for their business, funding their business, buying commercial assets, all these sorts of things, they are worried about 2027. Will it still be a good place to invest? Should I still load up on debt to take a risk for my business? Because what is the landscape going to be tax-wise politically? So I don't think they can get away with just saying, well, it's not coming in now, but it's potentially coming in the future, so it doesn't matter.
Can I just add one thing to that? The other thing that we get, and it might be because we deal with a lot of property investors and business people, is that even clients right now who are buying properties, there's this worry in the back of the head that, like, if Labor get back in,
what happens?
I don't think any country should have that worry when it thinks about whatever the political side of the coin they're on. Yeah, it's a perverse kind of reaction. Like, if you're worrying about a government that might get in or might not get in a year or 2 years' time, or whenever it is you've thought about that, then something's not right in our political spectrum and the policy
That's a
that
great
they're doing.
I do hear that sentiment quite a bit, though. I'm not going to go and do this thing right now because the Labor and Greens might get into the next government, which will have whatever impact off the back of it. It does feel like it's becoming more and more common.
Yeah.
So obviously, checks and balances is all about helping Kiwis improve their financial literacy, taking control of their future. I think the risk with something like this getting announced is people going, property's been down for the past few years. Property won't continue to go on the run that it's been going on. Look, now it's going to go and be taxed. I'm not going to go and buy an investment property. What are we thinking in terms of the implications of future property investors with a change like this? And do we think property as an asset class, as an investment, has it had its run?
Interesting you bring that up, because the other day Bill English came out and said we won't need a capital gains tax on property because we're not going to see those same annual returns as we have in the past going forward. So he effectively said it's going to be a waste of time as the returns from that asset class shift. I don't agree with him either. I still think it's it is just a tax on profit. So I still think it's a good asset class to invest in, and you're still getting the power of leverage, right? Which you're not getting with a lot of other investments. At the moment, it's twofold. You have some tax advantages and the leverage component to the investment class or to the asset class. I still think the leverage means it's a good asset class.
That's actually how you could kill investment property. Be like, you can't borrow to buy an investment property. That would kill it overnight.
Yeah, I think we've covered this in other podcasts as well, and I don't think property's yet. I agree that we're not going to see what we saw, but I think we are still going to see pretty good 4 or 5% returns annualized with leverage going to be totally acceptable. And more than that, if property investors aren't going to provide the accommodation, who's going to do that?
Yeah.
And what's that going to cost?
Last question before we wrap up, guys. So, Mike, and we've been talking about what we think will happen to the property market next year. Does a announcement that this might potentially happen in the future impact what will happen in terms of property growth in 2026?
Nope, I don't think so. I think the market will continue on irrespective of this announcement.
Markets do have a tendency to react to this kind of stuff, but they're largely forward-looking. And I think the bigger news is lower interest rates. The bigger news is demand for housing, and I think as we get close to the election, maybe we'll have some sort of impact. But I don't think in the next 6 to 8
Not
months
in 26.
it's going to do anything.
Yeah, and I would say that if you are going, maybe investment property isn't right for me because of this announcement, just make sure a headline doesn't scare you and that you make a bad decision in the future. Make sure that you get all the information, look at all the data, make an informed decision about your future, because these sort of headlines, these will happen multiple times a year, right, for the rest of our life. And if we adjust our plan based off the announcement and which way the wind is blowing, you're actually never going to get anywhere.
And we've seen it heaps with the stock market this last 12 months.
Yeah.
There's been sensational announcement after sensational announcement, and everyone who did the wrong thing there and overreacted, didn't end up in a great position.
Yeah, 100%.
All right, we'll wrap it up there. Let us know in the comments, what do you think about this announcement? Is it about time or is it completely wrong? Make sure to subscribe to the channel, give us a review, give us a like, and we'll catch you next time.
Cheers.